Okay, picture this. You walk into a giant candy store. You look around and you're thinking, you know what? I don't want just one piece of candy. I want a whole mix of everything. But the second you think that, three people just run up to you shouting, no, you gotta buy an index fund. No way, buy a mutual fund. ETFs. ETFs are the best. And you're just left standing there in the middle of the aisle, completely overwhelmed, thinking to yourself, bro, I just wanted some candy. You know, that feeling? Where you want something simple, but you're just hit with all this confusing complexity? That is exactly what it can feel like when you first start investing. So, today, we're going to fix that. In this explainer, we are going to break down these three really popular types of investments with absolutely zero confusing jargon. No boring stuff, just candy. I promise. Okay, let's dive right in. Before we can even get into what makes these things different, you have to understand the one big idea that they all share, and that is the concept of a basket. See, all three of these, mutual funds, index funds, and ETFs, are pretty much just baskets that hold lots of different investments. So instead of buying stock in just one company, like, say, Apple or Tesla, you're buying a whole basket that has a little bit of a bunch of different companies. It's kind of like getting a candy mix bag instead of just one single candy bar. All right, now that we've got the whole basket idea down, let's meet our first contender. This is the classic, the original, the mutual fund. Probably the best way to think about a mutual fund is to imagine a chef who is actively making a giant pot of soup. Now, the chef, who in the finance world is called a fund manager, is a real person whose entire job is to pick all the ingredients. They might be standing there going, let's add some tech stocks, maybe a sprinkle of banking stocks, and you know what? Let's throw in some chocolate chips for fun. They are actively trying to cook up the absolute best soup for you. So the key things to remember about a mutual fund are these. 1, it's a basket of investments. 2, it's handpicked by that professional chef. But here's the really weird part. You can only buy or sell it once a day, usually right at 4 p.m. when the market closes. It's like a store that's only open for 1 minute every single day. And because you're paying for that chef's time and expertise, these funds can sometimes have higher fees. Okay, so that's the chef-managed soup. Now let's check out our next basket, which takes a totally different approach. Let's meet the index fund. You see, an index fund isn't like some chef's unique creation. It's actually a lot more like a group photo. It doesn't try to be clever or pick special ingredients. Nope. Instead, it just copies a famous pre-existing list of companies, like the S&P 500, which is basically just a group photo of the 500 biggest companies in the US. And what's so great about that copying approach? Well, since there's no active chef trying to be a genius and pick winners, the job is way, way simpler. And because of that, index funds usually have very low fees. They're really designed to be a simple, super low-cost way to invest for the long haul. And that brings us to our third and final basket, which is kind of like the cool cousin of the group that's become incredibly popular. Let's meet the ETF. So if a mutual fund is that sit-down restaurant that only opens for 1 minute at 4 p.m., an ETF is the 24/7 drive-thru. It's built for speed and convenience. You get that same basket of candy, but you can get it instantly, whenever you want. Now, I know the name exchange-traded fund sounds super complicated, but it's really not. Exchange-traded just means it trades on a stock exchange all day long, just like a single stock would. And that's the secret to its speed. The price is always changing, and you can buy or sell your basket right in the middle of the day. So let's recap the ETF real quick. It is a basket of investments, just like the others, but its key feature, its superpower, is that you can buy and sell it instantly all day long. They also often have low fees, and they just offer incredible flexibility. Whew, okay, that was a lot of talk about candy and soup and drive-thrus. Let's put everything side by side so we can see the core differences at just a glance. And honestly, this table tells the whole story. The mutual fund is that chef soup you can only buy once a day. The index fund is the simple, low-cost option that just copies a list. And the ETF is the fast food drive-thru you can get into anytime. The main thing to remember is they all give you a basket. They just deliver it in very different ways. All right, so after all of that, it all comes down to the most important question, right? Which one of these candy baskets should you actually choose? Well, let's break it down based on what you might be looking for as an investor. Because look, there isn't one single best answer for everyone, but there are some really clear guidelines that can help you decide. So here is the bottom line. If your goal is a simple, steady, kind of set it and forget it approach for the long term, index funds are a fantastic place to start. But
If you want the speed and the flexibility to trade whenever you feel like it during the day, then ETFs are an amazing choice.
And that right there is the main takeaway. Don't let these fancy names intimidate you. At the end of the day, a mutual fund, an index fund, and an ETF, they're all just different styles of baskets. And why does owning a basket even matter? Because it gives you instant diversification. Instead of betting all your money on one single type of candy, you're spreading your risk across the entire store, which is a much, much smarter and safer way to invest. If you want simple finance and clear thinking every week, subscribe to Finance with Raj.